Hello everyone, I am Jaypee de la Cruz, and in this video, I am going to discuss the financial statement assertions. The financial statement assertions, also referred to management assertions, were already been covered in the first chapter of the book, Principles of Auditing by Hayes, Dazen, and Wallach. So, the assertions have been defined as the evidence gathering objectives and what the evidence must prove. This simply means that the assertions are a company's official statement that the figures the company is reporting are accurate. So, management makes implicit assertions that fall into three substantive testing areas: the classes of transactions and events, accounts balances at the end of the period, and the presentation and disclosure. So, there are 7 standard assertions. Those are completeness, occurrence, accuracy, rights and obligations, valuation, and existence. The other assertions are cut-off, classification, understandability, presentation and disclosure, and measurement. Based on these assertions, the auditor estimates the risk of probable misstatements and prepares audit procedures to discover sufficient appropriate evidence. To make it simple, the auditors rely upon a variety of assertions regarding the business. The auditors test the validity of these assertions by conducting a number of audit tests. So what I have said earlier, the management assertions fall into 3 classifications. As you can see in the presentation, the assertions that fall into the classes of transactions and events are occurrence, completeness, accuracy, cut-off, and classification. Later, I will go over the definitions of those terms in more detail. So, another is the assertions that fall into the account balances are existence, rights and obligations, completeness, and valuation. And in the presentation and disclosure are the occurrence and rights and obligations, completeness, understandability, and accuracy and valuation. Proceeding to the next slide. So the first category is the assertions in the classes of transaction and events for the period under audit. So these are transaction level assertions and mostly regard to the income statement. So the first assertion is the occurrence. In this assertion, transactions and events that have been recorded have occurred and pertain to the entity. The assertions is that the recorded business transactions actually took place. Occurrence. Next is completeness. All transactions and events that should have been recorded have been recorded. It is an assertion that the financial statements are thorough and include every item that should be included in the statement for a given accounting period. Accuracy. Amounts and other data relating to recorded transactions and events have been recorded accurately. From the word itself, accurate, the assertion is that the full amounts of all transactions were recorded without error. Next is cut-off. This assertion are transactions and events have been recorded in the correct accounting or reporting period. Last is classification. Transactions and events have been recorded in the proper accounts. Next category is the account balances at the period end. These are account balance assertions related to the ending balances in accounts, and so relate primarily to the balance sheet. The first assertion in this category is existence. The assets, liabilities, and equity interests exist. So, it is the assertion that the assets, liabilities, and shareholders' equity balances appearing on a company's financial statements exist as stated at the end of the accounting period that the financial statement covers. Next is rights and obligations. An entity holds or controls the rights to assets, and liabilities are the obligations of the entity, of course. The assertions of rights and obligations is a basic assertion that all assets and liabilities included in a financial statement belong to the company issuing the statement. The rights and obligations assertion states that the company owns and has the ownership rights or usage rights to all the recognized assets. Next is the completeness. all reported asset, liability, and equity balances have been fully reported. And last is the valuation. All asset, liability, and equity balances have been recorded at their proper valuations. Let's proceed to the last category, which is the assertions on presentations and disclosures. First, occurrence and rights and obligations. Disclosed rights and obligations actually relate to the reporting entity, and also the disclosed transactions have indeed occurred. Next is completeness. All transactions that should be disclosed have been disclosed. Next is understandability. The information included in the financial statements has been appropriately presented and is clearly understandable. Next is the accuracy and valuation. All information disclosed is in the correct amounts and which reflect their proper values. In simple terms, financial and other information are disclosed fairly at appropriate amounts. If you notice, there are some repetition of assertions in every category. There is a fair amount of duplication in the types of assertions across the three categories. However, each assertion type is intended for a different aspect of the financial statements, with the first set related to the income statement, the second set related to the balance sheet, and the third set to the accompanying of disclosures. Moving on to the electronic evidence, we all know that nowadays, every business uses computers to track and store information. This means auditors are increasingly required to deal with evidence in electronic form. Some of the entities' accounting data and other information may be available only in electronic form. For example, entities may use electronic data interchange or EDI or image processing systems. In EDI, the entity and its customers or suppliers use communication links to transact business electronically. Purchase, shipping, billing, cash receipt, and cash disbursement transactions are often consummated entirely by the exchange of electronic messages between the parties. In image processing systems, documents are scanned and converted into electronic images to facilitate storage and reference. And the source documents may not be retained after the conversion. With the growing use of computers and other information technology, entities have been processing important data electronically. Today, information technology is almost indigenous to the business environment. Information systems continue to have an impact on business processes, on the initiation and processing of accounting transactions, and therefore on auditing. Auditors must keep pace with these developments. Information technology often requires auditors to use electronic evidence to reduce audit risk to an acceptably low level. So this raises issues about the validity, completeness, and integrity of that evidence.